Imagine you're walking down the street and you spot a $100 bill on the sidewalk. You pick it up. Nice little win. Now picture the opposite. You reach into your pocket for $100 you know was there, and it's gone. A hole in your jeans, and it fell out somewhere blocks ago. Here's the strange part. That second feeling, the loss, hits you about twice as hard as the first one lifted you up. Same $100. Wildly different emotional price tag. This isn't a quirk that's special to you. It's one of the most reliable findings in all of behavioral science. It has a name, and it is quietly steering some of the worst money decisions people make. Holding on to losing investments, panic selling at the bottom, clinging to things just because they already own them. It's called loss aversion. And once you can see it, you can finally stop it from making your choices for you. So let's break down exactly how it works, and the handful of habits that switch it off. Let's start by putting a number on the feeling, because that's what makes this so powerful. Try this little test on yourself. I offer you a coin flip. Heads, you win some money. Tails, you lose $100. Simple 50-50 bet. Now the question, how big does the win have to be before you'd actually take it? In theory, anything over $100 is a good deal. Win 101, risk 100, the math is in your favor. But almost nobody says yes at 101. When researchers run this, most people don't accept the bet until the potential win climbs to around $200, twice the size of the possible loss. Sit with that. To make people willing to risk losing 100, you have to dangle the chance of winning 200. That 2-to-1 ratio is loss aversion, measured. The pain of losing is roughly twice as motivating as the pleasure of an equal gain. This came out of the Nobel-winning work of psychologists Daniel Kahneman and Amos Tversky. And that lopsided ratio, losses looming about twice as large as gains, shows up again and again across countries, across the lab and the real world. It's not weakness, it's wiring. Now let's see the actual shape of that pain, because this is where it gets beautiful. And where the whole thing clicks. Kahneman and Tversky mapped how we feel about gains and losses, and they drew it as a single curve. Picture a graph. The center point is where you are right now, your reference point, 0. To the right are gains, to the left are losses. On the gain side, the curve rises, but gently, and it flattens out fast. Your first $1,000 of profit feels great. The second 1,000 feels good. By the 10th, you barely notice. Pleasure has diminishing returns. But now look to the left, at losses. The curve doesn't just mirror the gain side, it plunges. It is far steeper. The drop from losing money is about twice as deep as the climb from winning the same amount. That's the entire idea in one image. Same distance from the center, but the downside is a cliff, while the upside is a gentle hill. When you win, you step up. When you lose, you fall, and you fall about twice as far. This shape is why a portfolio that's up feels merely fine, but a portfolio that's down feels like an emergency, even when the dollar swings are identical. Here's the twist most people miss. The dollars themselves aren't really what you're reacting to. You're reacting to the change from a reference point, and that changes everything. Think about how differently the same $10 can feel. Going from $10 to $20 feels enormous. You doubled your money. But going from $1,010 to $1,020? Same $10, but you'd barely feel it. We don't experience our total wealth. We experience the movement up or down from wherever we happen to be standing. And the sneaky part is that the reference point is movable, and your brain usually anchors it to the wrong thing, what you paid, or the highest number you ever saw. Say a stock you bought at $50 climbs to $80, then slips back to $70. On paper, you're up $20 per share. You're winning. But it doesn't feel like winning. It feels like losing 10. Because your brain quietly reset the reference point to 80, the peak, and now 70 reads as a loss. Nothing about your actual wealth changed. Only the number you're measuring against did. Once you notice this, you start catching it everywhere. The house that's lost value since the peak. The salary that feels low only next to a coworker's. Loss aversion doesn't even need a real loss. It just needs a reference point you've quietly moved. Now, let's follow this straight into your wallet, because loss aversion has a signature move in investing, and it's expensive. It's called the disposition effect. And it's this: people sell their winners too early and hold their losers too long. Exactly backwards. Here's why. Selling a winner feels great. You get to lock in a gain, bank the good feeling, take the win off the table. But selling a loser means admitting the loss is real. As long as you hold it, the loss is just on paper, and your brain treats paper losses as not quite real. Selling makes it official. It hurts, so you don't. The result is a portfolio managed by which choice hurts less, not which choice is smarter. One famous study of thousands of real brokerage accounts found investors were about 50% more likely to sell a winner than a loser. They were cutting their flowers and watering their weeds. And this same instinct drives the worst move of all: panic selling. When markets drop, the paper losses scream, the cliff in that curve takes over, and people sell at the bottom to make the pain stop, turning a temporary on-paper dip into a permanent, locked-in loss. Loss aversion convinces you to do the one thing almost guaranteed to hurt your long-term returns. So how do you disarm something that's literally built into your brain? You can't delete the feeling, but you can stop letting it drive. 4 moves. 1. Zoom out. Loss aversion feeds on close-up, position-by-position attention. So judge your whole portfolio, not each holding. And look at it less often. The more frequently you check, the more individual losses you see, and the more the pain compounds. Checking daily isn't discipline, it's self-harm. 2. Pre-commit. Decide the rules when you're calm, then automate them so the painful moment never gets a vote. Automatic investing every month, scheduled rebalancing, set sell or hold rules in advance. A rule made in daylight beats a decision made in a panic. 3. Kill the sunk cost anchor. Your purchase price is a fact about the past, not a reason to keep anything. The honest question is never, what did I pay for this? It's knowing what I know now, would I buy this today? If the answer's no, the loss already happened. Holding on won't undo it. 4. Trust the math over the feeling. When the long-run odds genuinely favor a move, that 2-to-1 dread is lying to you. The goal isn't to feel no fear. It's to notice the fear, recognize it's exaggerated by a factor of about 2, and act on the numbers anyway. So let's pull it together. Loss aversion means a loss hurts about twice as much as the same size gain feels good, a 2-to-1 ratio you can actually measure in a coin flip bet. You can see it in the shape of the curve, a gentle hill on the gain side, a steep cliff on the losses side. And it doesn't even track your real wealth. It tracks the change from a reference point your brain keeps anchoring to the wrong number, like what you paid or the all-time high. Left unchecked, it makes you sell winners early, hold losers forever, and panic sell at the bottom, cutting your flowers and watering your weeds. The fix isn't to stop feeling it. It's to zoom out, automate your decisions in advance, ignore what you paid, and trust the math when the feeling is screaming twice as loud as it should. See the pain for what it is, a doubled signal, and you take back the wheel. If loss aversion just explained a few decisions you've quietly regretted, hit subscribe. That's the whole point of this channel, the money psychology nobody ever sat you down and explained. And here's the perfect next step. One of the biggest moments loss aversion sabotages is investing a chunk of cash all at once. The fear of putting it in right before a drop. So should you invest it all today or spread it out? Watch the video on dollar cost averaging versus lump sum investing and see what the math actually says. I'll see you there.